Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
You have to understand that there are many different forces battling in Europe right now for control and power. It would be very important for us to identify at least some of them in order to interpret the events accurately. Here in this slide, you can see some key historical events, but you can check them out at your own time. It is very important to know this information because this way we can understand how the future was shaped, what forces created modern Europe. I'm just very quickly going to say that the Dawes and Young plans were simply the plans of the Americans after winning the First World War to rebuild the industry of Germany and impose their own terms. Large American corporations of the time helped rebuilding the factories, but they controlled all of the newly created German companies. I'm only going very briefly to talk about the concept of Mittel Europa, basically meaning Central Europe. Now, this concept was developed in 1915 by the German thinker Friedrich Naumann. He introduced the concept of Mittel Europa. As we said, it actually means Central Europe. But this concept is not only geographical or historic. It is also a strategic plan to rule this geographic region and exploit it financially. The German politicians accepted this plan during the First World War, and later, during the Second World War, the plan was also adopted by the Nazi government. So the main strategic idea there was to create a series of puppet states whose political, economic, and military aspects would be under the control of the Reich, of course. Now you might wonder, why is this important? Why is it important to know about the concept of Mittel Europa? Well, it is important because we were reading many articles at CNBC or Bloomberg wondering why is Germany risking to ruin all of the European Union for the sake of Greece. But if you understand the concept of Mittel Europa, it fully explains this. It is more important for Germany to expand its influence in Eastern European countries or in the Baltic states instead of Greece. We can move now to the next slide here, where we can talk about the root of today's crisis, which is the Maastricht Treaty. Obviously from 1915 and many other historical events, which we don't have the time to discuss right now, we were led to the Maastricht Treaty, which was signed by the European Union in 1992. This led to the creation of the single currency, the euro, and this treaty was the pillar structure of the European Union. As we said, the cause of the crisis, the cause of today's crisis, lies exactly in this treaty. With this treaty, the most powerful and technologically advanced nation in Europe, that is Germany, gained access with absolutely no currency risk to the markets of the other members. Exports were increased dramatically, but it was also good for other weaker economies within Europe, which were benefited since they gained access to cheaper credit with far better terms that otherwise wouldn't have received if they were members or if they weren't members of the Union. And this is exactly the problem. Countries like Greece, Spain, Italy, Portugal, which were basically traditionally agricultural societies, were able to borrow money with the same terms as the extremely production efficient and highly industrialized Germany. The money received, especially in the case of Greece, was used to finance the already significant debt. The Greek politicians, and it's important to know this, were hiding the problems using constructive logistics. Greece shouldn't have signed the Maastricht Treaty in the first place, since it did not meet any of the requirements. But thanks to a suspicious swap deal between the Greek government and Goldman Sachs, the Greek government back then was able to borrow 1 billion euros, but was not shown in the books. So the government was able to show a much better financial situation than it actually was. Then as the time moved ahead, we are in 2008, and suddenly we have a big financial crisis. And now for the first time, investors realize that the debt of Greece is actually larger than that of Argentina or Russia when they had defaulted in the past. They also realized that there was no plan in the Maastricht Treaty to explicitly say what happens in that case, in the event of a possible default by a member. And now the rest is history. The crisis escalated, the spread went to the roof, and now we are talking about rescue plans. Sorry, can you please move back one here? Okay. Now I wanted to talk to you about the issues facing Greece after signing the Maastricht Treaty. Now, the first three you can see here are some terms imposed by the treaty, but basically they were never met. Let me also tell you that Greece will not move out of the euro. This is impossible. It is extremely complex, and there is no legal way to do it. The Maastricht Treaty doesn't cover this scenario. Also, Germany will not allow this to happen. Even if Greece is not important for its strategic goals, it cannot risk further deterioration of the situation. You also have to understand that Germany is an important geopolitical power only through a unified Europe. With a unified Europe, Germany has very strong geopolitical and also political power. The biggest problem that you have to watch out in the future is the credit rating of the Greek banks. Beyond a certain level, they will not be able to borrow funds from the European central banks and help their liquidity. There will be great implications if the credit ratings are lowered. And I repeat again that this is something that you must look out in the future. Now, if we move to the next slide, going forward, the biggest danger, in my opinion, is that the crisis spreading to other countries that are facing very similar problems with Greece, such as Spain, Italy, Portugal, Romania, Hungary, and many others, believe me. Also, the situation in countries that so far haven't got a problem, for example, like France or Belgium, is only marginally better than the others. But let me tell you, why did I mention Hungary? What has this to do with the rest of Europe? I want to warn you, watch out Eastern European debt. Banks in Austria, for example, have lent money, and we are talking about a huge exposure to many Eastern European countries. They don't even dare to think a scenario where a country like Hungary, for example, or Latvia, or Romania suddenly defaults. The tidal wave would be huge. So I think Greece will be helped because other countries might find it difficult to sell debt at a good rate. And this is exactly the biggest danger. Let me move to the next chart. Here you can see the exposure on Eastern European debts. Now, look at Austria. Austrian banks have lent money to Eastern Europe at 65% of their GDP. This is huge. And also keep in mind that the majority of Austrian banks are a part of German banks. So you can imagine the implications.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.